Hey guys, on today's video I'm going to explain monetary policy. Remember a few videos ago I said that there's two ways to speed up or slow down the economy. The first one is fiscal policy, which would be the tools the government has to speed up, slow down. Taxes, government spending are both. So today we're going to focus on the other one, is monetary policy. Tools the Federal Reserve has to speed up or slow down the economy. Interesting fact, the Fed is not owned by the government. It's owned by member banks. The government does select a chair to the Federal Reserve, but otherwise they try to keep politics out of it. So the three tools. The first one is reserve ratio. This is the percent of deposits banks must keep in their vault to cover customer withdrawals. This is the least used of the three tools. They pretty much don't use this one. The second tool would be the discount rate. This would be the percent the Fed charges banks to borrow money. So if Chase wants to borrow money from the Fed, the discount rate may be 1%. And then Chase would charge customers higher percents, 3 or 4%. People with the best credit get what we call a prime rate. Currently, I believe the discount rate is 0%. The third and most important tool would be open market operations, OMO. This would be buying and selling of bonds. This is the most used tool. Okay, so let's apply monetary policy to the three tools. You have expansionary monetary policy. This is when we're in a recession and we need our people to go out spending money for our economy to grow. Contractionary fiscal policy is when we're all spending fast, too much, and we risk inflation. So the Fed wants to slow us down. They would implement contractionary. Reserve requirement. They would lower it for banks so that banks would have more money to loan out. Contractionary, they would raise the percentages that banks have to keep on hand so that banks have less money to loan out. Your discount rate, they're going to lower it during expansionary so that when banks go to loan money, it's cheaper for customers. So they'll take out more loans. And then when they want to slow us down, they're going to raise the discount rate so it costs us more to borrow money. And then the final one, this one is the most important one. When the government wants to expand our economy, they buy bonds, okay? So Federal Reserve banks buy government bonds from commercial banks or people. This will increase the amount of money in banks. So if we have more money in banks, then there's going to be more people spending, taking out loans, okay? So the opposite, when they want to slow us down, they sell bonds. They want to get you and I to buy a bond, so they sell it to us so that we take that money and give it to them, and we're not using it instead to buy TVs and houses and cars. This will decrease the amount of money in banks. Interestingly enough, when the Fed wants to buy bonds, they lower the interest rate for investors. So they're discouraging from you taking your money and buying a bond. They want you to buy stuff, okay? And just the opposite, when they want to slow down our spending, they sell us bonds. And so we're taking our money and not using it to buy things. Okay, so finally my recommendations for a book, Talking to Strangers by Malcolm Gladwell. It's a great read. TV show, Shark Tank. I thought it would be good to have my kids rewatch some of the episodes and then go and research how the companies fared after the show. Were they successful or did they flop? Email, there's a daily email that comes out called The Hustle. It's a tech business news. It's really good. It's thehustle.co/daily. And then businesses, I think it's a good idea for us to support small restaurants. I know in our area there's an Orange Leaf that's owned by former educators. So I think these small restaurants really need our business.